Hello everyone, I'm Chris Sullivan. I'll be your host for the latest installment in our Swiss Re Corporate Solutions Risk Management webinar series. Today I'm excited to welcome back Scott Carpentieri to walk us through a number of non-damage business interruption case studies in a choose-your-own-adventure style. This topic was presented earlier in the year, so if you're interested in watching or rewatching that, you can navigate to the Swiss Re Corporate Solutions events page and watch on your own time. And through polling throughout various webinars, you, the audience, have told us you wanted to take a deeper dive into NDBI. So here we are. Scott is part of our Innovative Risk Solutions team, where he works with corporate and public entity clients to develop customized insurance products. Now, before we get started, a few logistical details. The audience has been muted, and feel free to submit questions throughout the presentation. As always, we'll get into those at the end of our presentation. And then if you encounter any technical issues, please press Control F5, and that'll reset the platform and get you back in. Now, without further ado, I'll turn it over to Scott.
Thanks, Chris. Appreciate that. So thanks everyone for joining. I think we're having almost a monthly one of these through 2020 here in our new world, and we know we have a lot of people on the line today, and we've had a lot of people joining over the past several months on our webinar series. And so we really appreciate you joining us. We appreciate you taking time out of your days. And we hope that you're getting some value and having maybe a little bit of fun here with us too. I also want to take a moment to thank Chris. I think, Chris, you have hosted each and every one of these, if I'm not mistaken, including, if I'm counting correctly, there was a time you were on vacation. So really want to thank Chris for putting these together. And another voice that you don't get to hear is Shannon from our communications team. They put a lot of work into these, making sure that people like me are well prepared to deal with the technology and also just get the best content that we can out there. So a big thank you to Chris, and thank you to Shannon for that. And thank you to everyone for joining. And for those who've joined our previous webinar on NDBI, we're going to go into examples today, and we'll go a little bit deeper dive. For those that haven't joined before, and this is on non-damage business interruption, I'll curb my acronym use as much as possible. For those who've not joined the prior slide, as Chris said, the prior webinar, is out there. If you want to re-listen, we'll also give a little bit of a background here today, so you won't be completely lost if you're jumping into this one for your first go. And there'll be a nice little recap for those who maybe did join our previous one, which was now, I think, this summer, which was already several months ago. A quick opening comment. I know in 2020, when people hear non-damage business interruption, the first thing on their mind is probably COVID or pandemic or infectious disease. To just give you a preview on that, our appetite at Swiss Re for pandemic risk is virtually zero. The reason for that being we are a major insurance, reinsurance, life reinsurance company as well. And so when you look at Swiss Re's exposures as a whole, one of the peak exposures to Swiss Re would be if people unfortunately started perishing sooner than expected. So for that reason, it's also we're not sure how to calculate this event, and having an event that is globally correlated is also very, very tricky. So for those reasons, our pandemic exposure really does not exist. Hopefully people aren't dropping off right now and they're interested in hearing what we do have as far as appetite and the things that we can cover. With that, I want to just make another kind of comment about what we're about to hear about today, and then also compared to, say, the thing that's in the forefront, the pandemic. We do realize, particularly earlier in this year, there were a lot of inquiries about pandemic. I think people are now coming to the realization that the pandemic risk is real and something they need to face for whatever period of time in the future as part of their business and their operations. But unfortunately, life doesn't give you just sort of one challenge at a time. And so as we've seen, for instance, with the hurricane and wildfire activity, this year, there is the world still keeps throwing its punches, and so we want to focus on those other types of things that can be covered. Again, acknowledging that there is a big one on everyone's mind right now, but unfortunately those other things are also not going away. So with that, I'm going to jump into a little bit of recap on non-damage business interruption. And so we're just going to cover the basics here, similar to what we did on the last webinar, but just a little bit quicker this time, so we have time for some examples. That's the non-damage business interruption. Basically, is business interruption insurance, but doesn't necessarily require a physical damage trigger. I may use the word NDBI as we go through this presentation. I'll try to actually say it in its complete form, but we'll address that right away. That's what that acronym would stand for. So we'll talk for a moment about traditional business interruption insurance. So just a few comments about traditional business interruption insurance. Generally speaking, traditional business interruption insurance is largely found within the property form. And it's a way to get business interruption insurance to organizations. It's maybe less perfect than it once was when you had maybe vertically integrated firms. So if you had a company that maybe mined a resource, produced that resource into a full product, and then actually retailed and sold that resource, any physical damage to that chain would likely lead to the business interruption, and the policy worked pretty well to respond. In the modern age, though, we have a lot of organizations and entities that are much more specialized, and they do a piece of the puzzle, and whether that's sort of a manufacturing supply chain or even a public entity, they're really a piece of a greater puzzle of the community. Maybe the county organization is one piece of the puzzle that coordinates and collaborates with the city and the state and with the school systems and the fire departments. And so they're all sort of a specialized piece of a larger ecosystem. There are things that can happen to an organization's revenue stream that maybe have nothing to do with their actual assets. And so this is where the challenge has crept in with the breadth and the breadth of protection from classic business interruption insurance. So these bubbles here that you see on the current slide, so it's difficult to underwrite. Right? So if you think about sort of the carrier's side of the equation, the underwriters, the property underwriters, when it comes to buildings and how likely is a building to catch fire or maybe be damaged with a hurricane or a tornado or an earthquake or something, those are things that you can actually kind of get your hands around. You can look at the engineering, you can underwrite, you can get a sense of, yes, this is a risk that we're willing to take, and the appropriate cost for this risk should be about this because of our prior experience and our modeling. We can get a sense of that. When you're talking about supply chain and revenue, there are just a litany of things that could impact the revenue. It's very, very challenging, much more challenging puzzle to underwrite from the underwriter standpoint. And which is why there are limitations on the business interruption insurance in its classic form. These claims are also very complex to settle. I like to say that if you once had a 20,000 square foot warehouse and now it's gone, that's not the hardest claim in the world to settle. The job of the insurer is to rebuild the 20,000 square foot warehouse and of like quality and kind. And those claims, generally speaking, you don't hear too much about those claims being difficult or a challenge, and insureds and customers' expectations are usually easy to be managed and meet their expectations. When it comes to business interruption claims, those are very, very difficult. It's almost everybody has to break out their crystal ball and say, what would the revenue of this organization have been but for this event? Well, a lot of moving parts in the world. Very, very challenging to get that claim, to do a good job getting that claim to where it meets everyone's expectations. And then on the last point, this is, traditional business interruption is one of the few traditional ways to protect the income statement of an organization. And I alluded to this just a few moments ago, but when you think about the concerns of corporations or even public entities, the focus has very much drifted from assets to income, right? And so, and even again, when you think about even public entities, their revenue streams, whether it's tax bases or other sources of funding, really, really important to the vitality of these organizations. Corporations, the same. Turn on business news, you're not going to see a 20-minute story about balance sheets. It's going to be about earnings and income and looking forward. And so, we have these product, the classic insurance policies do really focused on balance sheet. Nothing wrong with that. They do a nice job, and it's very important for folks. But when it comes to protecting the income statement, we have some tools in the classic world that can do an okay job in some places and maybe not as good a job in others. So that's the genesis of why we want to talk about non-damage business interruption, why we've put some pretty decent amount of focus in our organization to figure out how can we open up the world of risk transfer a little bit more than what we've done traditionally. So it's a matter of making all parties happy, allow the clients to buy more coverage than they would before, do some more risk transfer for things that were not classically able to be transferred, but then also do it in a prudent way to where we're comfortable on our side, and if heaven forbid there's a claim, we feel like we put some good thought and analysis into it, and that's what could have happened. So one thing I like to do on these is to set expectations. So when it comes to non-damage business interruption insurance, this is probably the most complex thing that we'll do on my team, on the Innovative Risk Solutions team. So this is the group of specialists here at Swiss Re Corporate Solutions that really try to tackle problems that are unsolved for clients. And so the one thing that we want to say is that these solutions are very specifically tailored to clients' needs and concerns, and they generally don't take the form of all risk covers. And we know folks are used to seeing just all risk covers. I'm going to talk a lot about property insurance because that's where business interruption tends to live within. So in a typical property insurance policy, you see with the physical damage, all risk covers tend to be very prevalent. We have many years and decades and almost centuries of underwriting experience and techniques to underwrite those. With these solutions, much more specific, much more tailored. We're going to be isolating things that can happen that you can get your hands around, you can underwrite, and actually open that risk transfer door, or otherwise, way to put it is we can close that insurance protection gap. So the biggest thing to think about when you're starting to embark on a non-damage business interruption solution is to think about this continuum here. So we've got this continuum. On one end of the spectrum is a pure fortuitous risk. So easy ones are sort of the things that the earth throw at you, not controlled by the client, really not controlled by us, it just happens. So the natural catastrophe perils are very easy example of pure fortuitous risk. Doesn't matter what you do, an earthquake or a hurricane is going to happen or not happen. Really the insured has no control over it. On the other end of the spectrum are the pure business risks. So pure business risks are, I have a startup company, we think we're going to invent the new light bulb and it's going to change the world, it's going to use almost no electricity and it's going to be fantastic. It may or may not work. Can you insure against that? Well, that's actually the point of the business. That is what the investors are taking on, whether or not that thing will work or not. And then, so on that end of the spectrum, the pure business risk, generally those risks are best or most appropriate for the investors in the business itself, not usually of the form that can lend themselves well to insurance. On the other end of the spectrum, the pure fortuitous, absolutely, very straightforward. Those random events that happen in the world that are, have an impact on the organization. Those are insurable. The fun part is in the middle. There are events that maybe have an element of business risk, maybe have an element of fortuitous risk. Sometimes they're all knotted up together. Our job on my team here is to see if we can't unknot those a bit. Maybe we can take the fortuitous portion of a more complex risk, or maybe have a multiple trigger type of situation where we try to ensure what we can and keep it to the more fortuitous space, and then maybe have the organization or the investors in the organization keep the more business risk. So very important, very esoteric. I appreciate right now that we're going to get to concrete examples very, very shortly. And so just keep this in mind when you're thinking about these solutions, and we're going to hit these points again through the presentation today. So this slide, this is probably the most important slide you'll see today, and don't worry, you'll see it again. How do we go about solving one of these non-damage business interruption policies? How do we tackle one of these problems? How do we determine what is doable and not doable? How do we work together with our broker partners and our clients to solve these what seem to be unsolvable problems? So the key is to find triggers or events that you can key off of, right? So a lot of folks, when they think about non-damage business interruption, so they say, okay, business interruption, great, so I'll just have a protection in case the revenue drops, right? Can't we just use the revenue as the trigger? Well, the tricky part about that is it's kind of commingled, right? So if you think about that prior slide, the revenue can drop for business reasons, bad management decisions, etc. Not really insurable. That's sort of meant to be the risk of the owners of the business. But the revenue can drop for other reasons that are insurable and are underwritable and are measurable. So our job is to try to tease out what those things are. So together we'll figure out what a trigger is, what an event, what a measurable thing in the universe is that's sort of outside of the client's business risk and outside of their control that we can actually use to build one of these trigger-based solutions. So item number one, this thing we're going to measure in the universe, is it correlated with the financial loss to the insured? Because that's what we're trying to protect. So some items are very, very correlated, and it's a direct one-to-one, and some items are maybe loosely correlated. And we have to think about those and how we structure these, both with where we set the triggers, managing client expectations of how well the product might perform or how well the solution might perform. So that's step number one. Step number two, this one's very important to us. Is it objectively measured? So we really don't like solutions where it's the client saying, hey, you should have seen what was happening over in my operations. Just lends itself to a lot more scrutiny we'd have to have, and everybody has studied their sort of moral morale hazards and that sort of thing. Also, ideally, it's not us making up the information either, because it's the reverse issue. So if I'm in the client's shoes, I kind of don't want Swiss Re telling me whether or not this thing happened in the universe. I'd prefer that it was someone independent measuring it. So that's second item is if we can find an independent measurement, those are ideal for these types of solutions. And again, the number three is a little bit of an overlap of that. So so I actually I commingled 2 and 3 there. Bear with me, folks. So yeah, so number 2 is objectively and quantifiably measured. So if there's a concrete number that the thing happened or didn't happen, and then number 3 is there someone independent who's doing that for us? And then number 4 is there sufficient history on this measurement so that we on our side of the table can underwrite it and figure out what the fair price is to charge for this. It may be something where there is sufficient history. It may be something where it only happens once in a while, and we may have to build a mathematical model to determine what we think what the fair price should be. It may be a combination of those things, but ideally, if there's some sort of history or at least some way of forecasting what this might be, this is where the pandemic, for instance, becomes a challenge on that item 4, what is the probability of a pandemic going forward? It's hard to say. There are historical examples of pandemics, but has the world been changing, with the interconnectedness of people, that maybe the 1918, I believe that year is, maybe that pandemic is not as indicative of what could happen either in 2020 or maybe 2030. So these are the things that we have to figure out when we're looking at these types of solutions. So one more expectation setting. Again, these are highly customized, bespoke solutions, and they require a time commitment from all parties. So really, really important here. We are absolutely happy to put in the time, but just want to make sure everyone is clear. This is not the type of thing where maybe a broker phones us up and says, hey, I saw your webinar. I got this thing. Can you put a quote together, in 48 hours? It just doesn't work like that. There may be solutions where we have a lot of experience, and we might have a lot of prior work that we've done to where we actually may be able to drive a solution in a decent amount of time, and with maybe only a little bit of input from the broker or the client. But most of the time, it's us all putting our heads together because the client knows their business and their industry so well, and we know our capabilities and how we try to solve these problems. And when we put our heads together, it's where these solutions come together. I don't think I've ever seen one of these solutions where we got near or even over the finish line without the engagement of the parties, particularly our broker partners. And for those who we've executed with these, we thank you very much for your commitment. We know how much work it is from everybody's standpoint. So with that introduction, we now can jump into case studies. So appreciate everyone's patience as we hit that recap. Want to start off with a very simple example. So like easy ones, and then we're going to get a little more complex, and we're actually going to look for a little bit of feedback from you. So for those who maybe are multitasking, be ready. You want to jump over to your browser window soon here. So number one is, as I said, it's a very simple example. Simple from our standpoint, maybe not from the audience standpoint. We'll see if people are wowed by this, or if they say, yeah, I got that. Let's build on from there. So how do you get to business interruption insurance coverage when you don't actually own any assets? So this is a real example that we had that came across our desks. So again, classic old school manufacturing. I dig something out of the ground, I smelt it, I form it, I have a product, I sell the product. You've got vertically integrated companies. Physical damage, easy to measure. The business interruption, easy to measure. It's likely tied to the physical damage. Those are most of the things that can cause the revenue interruptions. We have modern companies now where you don't even have to have an asset. You could have an electronic platform. You can have ecosystem. In this case here, it's a network. It's a facility. It's an organization that helps facilitate home healthcare workers. They don't actually own assets. The business, the product takes place in the homes of their customers. So they have very, very minimal real estate footprint. So how does an organization like that get revenue protection? You have, again, state of Florida, one huge risk is hurricane. So if you think about what would happen in the event of a hurricane to a company who provides home health care workers, well, first of all, if there's serious damage and devastation to the area, there's a very good chance that the residents, the ultimate customers, they're going to evacuate from their homes. They might stay with some family or friends, and maybe their homes are damaged. So there's going to be a period of time before those ultimate customers are back in their homes. Well, is the home health care worker going to still be providing services to them? If they're nearby, maybe. If they're with friends or family who can take care of the relative, then maybe they don't need the home health care workers. Once you have people who are displaced in this kind of business, very possible that they find a new way. So maybe the folks evacuate from their homes and they realize, you know what, I'm just not going to do the independent living anymore. This was a very scary event. So this firm recognized that they'd have both an immediate interruption to their business with evacuations and such. In addition, they may have more permanent displacement of their customer base. Maybe the folks would move into more assisted living care facilities, and so the home health care worker provider is now actually got to rebuild their business a bit from scratch in this particular area if they were hit by a hurricane. So very real problem, very, very real problem, and hard to solve it with the traditional products. So this is a little picture here of a picture of what their revenue might have looked like. And so what we did is we said, okay, let's look to see, let's tackle the hurricane risk. Right? There's other reasons why people may stop having home health care workers, but some of those may be more business risk, some of those might be fortuitous, but the big fortuitous one that we can get that one off the table right away is a hurricane. So we literally looked at they didn't have an asset schedule, but they had a revenue schedule. And so we said, okay, where are the key places where you have big pockets of revenue? So if it's a part of the state that maybe it's just a small footprint of their client base, not the end of the world from the standpoint of the home healthcare business. If an area was hit that maybe there's just a handful of customers and workers in the network. But if you have an area that's super concentrated, where there are many, many customers and many, many home health care workers, that could be much more impactful to the ongoing operations of this business. So we could use that. We use the geography and the revenue as a place to sort of represent where their assets are, and where the revenue is coming from, I should say. And so, or as a sort of a proxy for assets. And so we use this, and for those who have tuned into our parametric NatCat webinars, this is a cousin, a very, very close cousin of that, to using those natural catastrophe triggers for a non-damage business interruption situation. So I started with that one because I know a lot of folks have joined those other webinars, and very, very popular topic these days is parametric NatCat, and also easier to get your head around because you can kind of picture it, right? So we basically put triggers on the map of Florida. The more intense the wind speeds are in these different areas, the more likely there's going to be more displacement and interruption to this particular organization's revenue. So simple example there. Now we're on to the interactive part. So the next case study I want to cover, we're going to actually let you choose. And so the choices will be, and these are set up to be a little bit teasers. So there's a volcano example, and it has to do with loss of attraction. There's a supplier's property damage example. There's a fog example, which has to do with loss of revenue, loss of significant revenue. There's a labor cost example, which has to do with unexpected spikes, not strikes, but spikes in labor costs. And river flow, which has to do with delay of construction for a project. So I'll advance this slide, and I understand there's a tiny bit of a lag here, so I'll let everyone think about those choices, and you get to choose the one that you would like to hear most. Time permitting, we probably will get to a couple of them, but wanted to see where the audience felt that they'd like this to go. And I'll just give everyone a few moments to make your selections, and then we'll show the results. Okay, I'm going to show the results now. Again, I understand there may be a little bit of a delay between the audio and the video. So excellent. I like everyone's choices. So if you haven't seen the screen yet, I'm going to spoil it for you. The top selection was supplier's property damage. That's a good one. I like that one. And it's a very close call for the others. So that's exciting. That's good. I think we've teased everyone's expectations or teased everyone's curiosity a bit here. So with that, Supplier's property damage. Thank you so much, Chris. We're testing the the extreme of our technology here, having the choose your own adventure slide. So we're literally having the slide deck jump around to the right place. So that was fun, and that was actually a live poll. We did not we did not fabricate those numbers. We literally did that live and have this one. We just jumped to the slide here for you. So case study, supplier property damage. Yes, this one's very popular. I can totally imagine, you know, resembles contingent business interruption on all those things that we attempt to do in the traditional space, and to some extent we do it okay, and some extent it's a little bit tricky. Again, it all stems from, you know, can you underwrite that thing that we're trying to insure here. This one actually, the example I'm going to show here, it's one huge corner of non-damage business interruption space that we actually really enjoy working in, because it really can solve a lot of problems, and it utilizes our expertise, which we already have, which is a great combination. So here's the example. The client uses a third-party pipeline. So the client is an energy company, and they contract a pipeline. Right, that's not that uncommon. Pipelines are almost just like, you know, big continuous trains that run through states and counties and regions. So the client contracts with a third-party pipeline, and they move energy assets from the field to a terminal for export. Right, pretty straightforward business model, and again, this is a classic example of how everybody's got a specialized world these days. This company is really an investment company that is basically dealing with the moving product from one into another, actually moving the product from one market to another. And the pipeline, they specialize in the pipe itself, right? And so everybody's got their own piece of the equation. If the third-party pipeline goes down, to regular insurance perils, so whether it's a fire or a explosion or perhaps an earthquake, the revenues will be lost from the actual client. Now, will the client be able to have recourse against the pipeline? For major events, generally there's a force majeure clause that says, I promise to move your stuff unless something really bad happens and I don't have to. And I'm way oversimplifying. I appreciate for those energy folks on the call here. But generally speaking, this is something where I'm relying, the client is relying on somebody else's assets, somebody else's business working properly so that my business can work properly. So the question is, can we design a damageability trigger based on damage to the third-party assets? And so we're going to jump ahead to this slide that you're going to get very familiar with today. So number one, what is the trigger that we're thinking about here? So the trigger we're thinking about here is damage to the pipeline, right? So our client doesn't own the pipeline, but our client needs the pipeline to work. And can our client buy a policy that triggers based on somebody else's asset not functioning or being broken or destroyed? Number one question is, well, is that correlated to our client's loss and loss of revenue and income and profits? And the answer is absolutely yes. It's not like you've got 20 pipelines all in a row and you can just use the other guys. If that one's broken, they generally are very specific in where they go, and there's not a lot of alternatives when you're trying to get from a specific location to another specific location. So yes, very, very correlated. Even if there was an alternative, they probably will cost them more because they don't have an in-place relationship, and there's probably going to be some disruption to the normal business model to make that other pipeline work. So absolutely a cost correlated to this event. Is it objectively measured and quantifiable? Yeah, in this case, pretty much so. If this pipeline is down, there's actually a lot of government information on, there's regulation on pipelines, so you can kind of learn from there. These are also major assets and major industry events. If one of these pipelines would go down, it's fairly knowable that this happened. So, yep, objectively measured and quantifiable. Yeah, pretty much. Is it third-party measuring? Again, there's a lot of objective, lot of data that you can get about the usage of the pipeline. Pipeline's certainly going to notify our client officially saying we can't deliver because of whatever happened. So that bubble is checked. And in this case, the trigger was a full outage. The client was not concerned about one of those minor situations where they're only moving at maybe half capacity. It was really more the mega situation. So the pipeline is fully out. Nobody's moving their product through the pipeline, and it's out for a meaningful amount of time. The more sort of nuclear event. And then number 4, is there sufficient historical data? Well, in this case, because the trigger is more damageability to an asset, well, we have expertise on pipelines. We have an energy team that underwrites and insures pipelines all the time. So while this particular insured doesn't own the pipeline, they use the pipeline, but we know how to underwrite pipelines. So we use our knowledge of the pipelines, knowing which pipeline they use, and actually from what part of the pipeline to one part to another part of the pipeline. We're familiar with pipelines. We're familiar with the pumping stations and all the where it crosses a river, where there's all the vulnerability points. We can actually analyze that. And in this case as well, it actually ended at a terminal, and we know how to analyze terminals. So in this case, we didn't necessarily have to use specific historical data on that pipeline. How often was that pipeline down or not down? Although definitely take that into consideration. But in this case, it really uses all our normal knowledge about insurance damageability. So we could actually work with our traditional property underwriter, our energy underwriter, to say, okay, can you help us design a model that says what's the probability of a pipeline going fully down? And then we have that other dimension of time for a significant period of time. And then once that happens, we will indemnify the client X number of dollars per day, sort of to replicate the lost revenue and profit they would have had. And we could build a trigger that says, if pipeline's down completely, there's a wait period. After the wait period, we indemnify the client based on the normal volume that they normally would have pushed through the pipeline, and we will pay them an amount equal to X amount per day up until either the limit runs out or that the client or the pipeline is back up and running and restored. So very, very straightforward. After it's done, it sounds easy. In the beginning, you have to put these pieces together, and something that again, this one's a close cousin of what we try to do in contingent business interruption land, but in this case, it's a lot more specified. So instead of being very broad, where the limits are generally pretty compressed in normal business interruption or contingent business interruption, the limits can be a bit wider here because we're focusing on exactly what could happen, exactly where, things that you can really underwrite, and a predefined payout as well. To where everyone knows what to expect if this happens. We don't have to go through a litany of years of claims adjudication. So that's the first item. And so I think we have time before Q&A. We definitely have time before Q&A. So let's hit the fog one. I think that was also got a pretty good response, and it's also a fun one. So yes, so fog, loss of revenue. And actually, before I just jump on the damageability triggers, to give you an idea, aside from the pipeline example, we've done damageability triggers with all sorts of folks that have business models that interlink with another business model, and if that property of the other party is destroyed, that wrecks the business, the revenue and the profit stream of our client. If it's something that we can get some information on and get our hands around it, we can make actually a damageability trigger. So those are really fun ones for us because it really relies heavily on what we do every day as an underwriting organization. And if we can use our normal underwriting skills to help a third party who also has interest in those assets being up and running and functional, we can create some very interesting and clever solutions. On to fog. So fog is an interesting. So fog's a weather, not exactly a nat cat, pretty common phenomenon, and fortunately, most people are not even injured or fussed by fog. But real impact to some business models, and we've actually done a couple of fog deals. The one I have here is an interesting one. So the client business is a client that operates a very famous observation deck with significant average daily revenue. And so for those who've done family vacations, and you get 4 people to visit an observation deck, and it's a real money, and it's a real business model, and they do a nice job. So the client concern is what happens is on foggy days, tourists don't visit the observation deck. They conclude that, well, if I can't see the sky, I'm not going to go out on that deck because I'm not going to be able to see the vista, and why bother? So sensible, and the tourists are probably right about that. The interesting thing is when you're trying to run this business, and this observation deck is a business, that's a thing you have to try to account for, and you've got to budget that into your annual plan and what you think your revenues and your profits might be for the year. And when you think about your investments and your bonds and all these other things, like, well, what do you how do you plan for that? Well, in this case, for this particular geography, the number of fog days each year ranged from maybe 40 on the low side to 80 on the high side. So when you think about each day of revenue is decently meaningful, to try to plan for, is it going to be 40 days of fog where we lose revenue, or 80 days of fog where we lose revenue? That's a huge volatility. So the question is, can we design a cover which smooths out year-to-year volatility? Well, you're probably going to guess this. Spoiler alert, the answer is yes. And so how do we go about that? Hopefully you're getting comfortable with this next slide here. So number one, is the fog correlated to financial loss? Absolutely. So yep, that sounds like that could be a very good trigger. Is it objectively measured and quantifiable? Well, it turns out in many jurisdictions in the U.S. and in other parts around the world as well. I know our friends from Canada are joining us today as well. There are weather stations that actually will tell you how much rain there was in a particular day, what the temperatures were for a day, and there's actually a visibility index at many of those stations. So if that station index is correlated to what the client experienced from their revenue and their back history, then we can see this. So that's one of the steps we did on Bubble 1, is saying, okay, is fog correlated? Yep, great. Can we get that data somewhere? Bubble 2, is somebody actually measuring this? Yep, there's this visibility index. Great, let's check that against the data and make sure that this particular station is a good indication of what that client was feeling at that asset. And the case was decently correlated. Not exactly, not every single station fog day and observation deck were the same, but they were close enough in a given year. When you added up all of them for a year, the numbers were strikingly close. So again, these don't have to always be perfect, but we want to make sure that everybody's clear on how good the measure is, the trigger is that we're using to measure the thing. And in this case, the client was going to take a significant number of days on their own. They were really just trying to smooth that volatility. So, if there's a type of thing where there was only 1, 2, or 3 days, we'd want to make sure that that station was dead on to what their experience was. If we're talking about somewhere between 40 and 80 days, if any given day is one way or the other, not the end of the world, because in general, a super foggy year is going to be a super foggy year, and a less foggy year will be a less foggy year. So is it quantifiable? Yep. Did we back check it to Bubble 1? Yep. Does it look pretty good? It does. Number 3, is it independent? Again, one of our little sticking points. These are independent. This is not a station on the observation deck because, again, really hard to control and make sure everything is super objective and on the up and up. We also, I think at one time, one of the first inquiries were, the employees will just note if it's a foggy day or not. Can you just adjudicate on that? Unfortunately, that's a little difficult. We prefer to have it to be a little bit more objective than that. Don't want to have to audit the files and deal with any of those types of hazards. And then, is there significant data? I will tell you, for as much of a modeling company as we are, we don't necessarily have a fog model, but fog is a frequent enough event, here we go, between 40 and 80 per year in this particular location, where we could look at the back data and we could see what the general volatility is. We could see if there was a trend, you know, is climate change or something affecting fog. Don't think it actually is in this case, but we could see if there was, you know, a general drift of one way or the other and over the long term, and if these stations have long historical data, which many of them do, we could do a pretty good job modeling that. So we were able to put together a solution that allowed the client to take maybe an average number of days. I think what we used as a trigger was maybe 50. So again, normally the pain, there's, you know, on a good year, there's only 40, definitely budget, you know, for 40 lost revenue days, but on a bad year, there's 80. So well, I think we had a trigger that kicked in around 50 or 60. And again, these are flexible, so you can design them, you can really customize, you know, what part of the sort of pain distribution, so to speak, do you want the insurance protection to kick in. And with that, I think we'll jump to Chris and maybe give some time for some Q&A.
Absolutely, Scott. Well, Scott, if you wanted, the next voted up topic was river flow. So if you wanted to go through that for 4 or 5 minutes, we still have time. Otherwise, we have plenty of questions, just the amount of time it would take you to walk through that example.
Yeah, let's do that. And in fact, before we jump to
Sure.
river, I'll also mention that this fog idea, so if I know brokers and client risk managers that are out there in the audience, I know your wheels are turning right now. This fog example, we actually applied the same concept to a firm that was doing exporting at a port. So their nature of their business was there was basically nonstop exports. So if there was a day where the port was closed due to fog, or the pilots found that it was too dangerous to bring the ships in and out of the port because of the fog, that revenue there was a major disruption to revenue. And there, again, if there's a certain number of these, if there's just the same number of events every single year, just budget for that. Would love to sell you an insurance policy, but if it's the same number every year, just budget for it. But if it's something that's very volatile, well, that's what we can do. We can help smooth that volatility for you and give you more of a certainty rather than having every other year, you know, it's a killer year or a great year. All right, river flow. This is another interesting one. So the situation is there's a client who's a construction company whose expertise includes river bridge construction. I get to learn about a lot of stuff in my job, being the sort of the jack of all trades, and so I get to learn about this thing called a cofferdam. So what happens is when building bridges across rivers, you'll need to access the river bed, and so there's a temporary dam that's built around the area you need to work in, so you can actually get machinery and people to walk on basically the base of the river. So they'll kind of redirect the river flow to maybe one side of the river, or sometimes there's a side of the river project, and but they'll redirect the river using these temporary cofferdams. They do a good job. They keep the water out, and you can go and dig holes and do what you need to do at the base of the river. The problem is they're not meant to be temporary. They're not meant to be permanent, right? They're going to remove those dams, those temporary dams, after the construction is completed. So as such, they're meant to do a good job holding the river back, but they have their limitations. So in these cases, if the river flow, so that's the pressure of the river, so that's because of speed of river and height of river, so it's a combination of the two. The river flow, if it's beyond a certain amount, it's not safe to have people and equipment in there. That's pushing the limitations of the elbow room that people want to have for pure safety of being in that space that the dam is creating. So what happens is this is another thing that's variable and volatile. In a given year, depending on the river, you may have 20 to 50 of these days where you actually can't do the work inside the cofferdam. Well, again, volatility, variability, very hard for folks that are trying to budget, particularly in the case of construction where you have this dichotomy between the construction company, the contractor, the actual project owner who's financing the project, who pays for the overruns if there's a lot of lost work days. Depends on the project and a very complicated dynamic, but in the end, it will cost somebody something. And so we've been approached, and we've worked on a few of these solutions to say, can you build a trigger just based on the water, the river flow, if it exceeds a certain number of days? So the answer, of course, is yes on that. What we did is there are tidal gauges throughout many of the rivers, and so we can use a nearby tidal gauge, or sometimes a combination of tidal gauges, to show those are measuring the flow. So we have that independent. We'll go to my bubbles again here. So certainly the flow leads to pain, financial pain to the insured because they're losing work days. They also is it objectively measured? Absolutely. The river flow is something that is measured at these river gauge stations. Is it independent? Yep. I think in this case the USGS monitors those in the United States. They exist in Europe, and I have not worked on a Canadian one yet, but I'm certain there must be river gauge stations in Canada as well. And is there significant history? So that number 4 one is a tricky one with the gauges. Some of the gauges are very new, and so we might not have a good sense of how this river ebbs and flows, literally, from year to year. But if there are many of the gauges that are very old. In fact, we worked on a deal earlier this year that I think the data went back to 1930, so it was a fantastically long history. So we really got to understand sort of how the volatility of year to year has looked over a long stretch. So we were very comfortable with the modeling and the costing that we were able to put together for that client. When it comes to these river sort of flow triggers, one of the things we'll be mindful of is if there is a dam nearby. Now you have a human element. It's just a matter of nature taking its course, and there's a lot of heavy amounts of water and light amounts of water. There's actually a human component as well. So that can be a problem. In the case of one of these that we worked on, the dam was there for so long that we actually had a good history of what the human element was as well. And so we actually had a sense of the very extreme times where they did have to open the dam, and so we actually got comfortable on that one because of the huge amount of history we had. So it was very exciting to be able to deliver a solution and really gave the contractor some optionality to their ultimate customer, the owner of the project. How about that, Chris?
Excellent, Scott. Thank you so much. That was excuse me. That was fantastic. We have a number of questions that have come in, and for the audience, we have about 5-6 minutes. We'll get to as many questions as we can. Those we do not get to, we will follow up with you directly. So thank you. I think we wanted to invest a little bit more time in the case studies, so here we are. Okay. Right away, Scott, here we go. I noticed you did not have any explicit travel or tourism interruption examples or triggers. Isn't that one of the places that one could use this concept?
Yep, no, it's a great question, and thank you for asking that. Yep, for those who are paying attention and you saw our introductory webinar, we did have that listed as a thing that we've actually done in the past in several different ways and shapes and forms. Generally speaking, yes, tourism is very measurable. We've done it for hospitality folks. We've done it for municipalities who rely very heavily on tourism for their revenues. The triggers we like to use are flight traffic and also hotel, what's called RevPAR, the revenue per average available revenue per room. I know I jacked that up, but sorry. Yeah, so basically the average price of a hotel room in a particular area. Again, very measured objectively, not controlled by just one source. It's everybody's pulling everybody's data together. Those are great solutions. At the moment with COVID, all of that data is really is really messed up because the industry is being, so we're in the middle of a very slow-moving event right now. So we would absolutely be open to having one of those discussions. It would be a complex discussion because, again, we can't cover pandemic, so that would have to be an excluded reason, and then we'll have to almost wait for this data to stabilize, because usually what we'll use as a trigger is a year over year. So if year over year the number of flight traffic or the average hotel rates drops significantly, then we can trigger. Well, 2020 is already a messed up year, so 21 versus 20, we'll have to figure out how we make a trigger that's appropriate, that makes sense for the insured. But definitely good question, and we will be doing those again in the future. This year they're going to be challenging, but we're always happy to have a dialogue to talk about those challenges.
Thanks, Scott. A number of questions come in around how do we price this product? And then, Scott, if you could also address maximum capacity available as well, because we had a number of inquiries on that front as well.
Great. Yep. No, appreciate that. And thanks for the questions there. So how do we price them? So you saw kind of technically in the presentation that we try to find data and use a combination of the data that may be present for the trigger that we're talking about, or triggers plural. And also, if it's something that we feel like we can model or analyze or underwrite. What we try to do is, for many of these solutions, there is a bit of a sweet spot when it comes to price. They tend to land somewhere in the maybe 2.5% to 5% rate online range, and that's a term we like to use in my space, in my team a lot. So rate online is premium divided by limit. So that's where the sweet spot tends to be. Now, very flippant of me to say, well, here's the price, and I don't even know what the heck the trigger is that we're talking about. But with the nature of these triggers, there's usually you set the threshold to how bad the event is or how much before the insurance kicks in. There may be a wait period in some of those time or frequency events. So the idea is to try to find that sweet spot. Most of the clients do want more of a sleep at night cover. Most folks don't have an appetite to buy something that happens, every third year. They're probably more efficient to just budget for that and maybe put a sinking fund together. But for those things that are maybe less frequent, but if it happened, it really is a bad day. Those are where we try to solve those. When it comes to limit, it kind of depends on how esoteric the thing is. So if it's something really out there that we feel like we can get our hands around, but this is pretty different than what we do on a day-to-day basis, we might have limits of maybe $10 million. If it's something that we actually feel like we can get our hands around, and it's something that really dives well with what our expertise are, like for instance, any kind of NatCat trigger in a non-damage business interruption, the limits can be more meaningful and in sync with more of our normal natural catastrophe type appetite. So it could be maybe a $40 or $50 million limit. And then so maybe things that are in between, like those damageability triggers. I've seen those where we were pretty comfortable at maybe 20, 25 million. It really just depends on how weird is the thing, and the more weird, we might go for a little bit lower limit. If it's kind of more normal, in insurance speak, normal, we can go for a bigger limit. And then also the other thing is we're going to be mindful of is how correlated is this to other losses in Swiss Re. So if it's a weird thing that can happen in some little corner of the universe that doesn't really impact any other insureds, we might be able to have a little bit more limit versus a thing that's going to be correlated to other things that happen in our portfolio.
Scott, well done. You kept us right on time and addressed some important questions. Again, we'll get to those who asked questions we didn't have time to get to. We will follow back up with you. Before you go, I ask that you please complete the poll that's on the screen now. We do these webinars for you, and we want to make sure we're being really good stewards of your time. So your feedback is super important to us. And really, that's all the time we have. I want to thank Scott again for presenting. He's been a regular fixture in this series, and I think you could feel his passion when he talks about these topics. And for you, the audience, for spending the past hour with us, we really appreciate your time. In the coming days, we're going to be sending a recording of this webinar, so you can rewatch or share with colleagues and friends as you see fit. And please reach out to Scott or I if you have any questions. Our contact info is up on the screen here, and we'd be happy to continue the discussion with you. And lastly, we have a few more webinars. I'll highlight the next one on November 10th, which will be on the topic of emerging risks, black swans, or risk radar for the future. We're going to have Stephanie Ott, our head of qualitative risk management for Swiss Re, presenting that topic. And that's a summary of our SONAR emerging risk key studies from the Swiss Re Institute. So stay tuned for invitations. Please watch the Swiss Re Corporate Solutions LinkedIn feed for updates. You should follow that if you don't already. And with that, again, a last thank you to the audience and Scott, and I wish you all a great rest of the week. Take care.